Ladies and gentlemen, I am extremely pleased to present you our 16th annual In Gold We Trust report. It has been a turbulent start of the year. The lingering effects of COVID lockdowns, supply chain issues, turbulences in markets, and obviously the war in Ukraine. And now, inflation is the topic again. For us, it was especially exciting, but also demanding to write this year's In Gold We Trust report, as we were confronted with high volatility in markets. On a global basis, bond and equity markets have declined by 23 trillion in market capitalization from its peaks. So we basically see asset price deflation and simultaneously consumer price inflation. Gold has played its role as a portfolio stabilizer quite well. It's very stable at around $1,800 on a euro basis, and this might be a surprise for many. Gold is up almost 8%. This year's leitmotif is centered on another issue that is rearing its ugly head: stagflation. Stagflation 2.0. But before we present you the highlights of this year's In Gold We Trust report, we would like to thank our fabulous team and our premium partners. As you know, year after year, for 16 years now, the In Gold We Trust report strives to be the world's most comprehensive and most widely recognized analysis on gold. Our aim is to publish the gold standard of gold research. And over the course of the last 16 years, it has really become a huge undertaking, and it would not be possible without the support of my fabulous team of 20 people working basically day and night on 4 different continents. In the last couple of months, together we worked for more than 20,000 hours. We were researching, writing, crunching the numbers, preparing the charts, translating, layouting, and preparing all the media work for our In Gold We Trust report. And now, finally, we are very pleased with the result of our work. So a big thank you to the whole team. You're indeed the best. And it would not be possible to publish the In Gold We Trust report and make it available for free in English, in German, in Mandarin, and now, starting this year, also in Spanish, without the support of our premium partners, the crème de la crème of the gold industry. Now, ladies and gentlemen, I am pleased to present you some highlights of this year's In Gold We Trust report called Stagflation 2.0. In the fall of 2020, we were prompted to publish a special report of the In Gold We Trust. In our publication called The Boy Who Cried Wolf, Inflationary Decade Ahead, we used Aesop's parable to issue an urgent warning about the danger of inflation that is creeping on us. Now the wolf called inflation is here, and it dominates the headlines. Inflation is a big topic again. But many investors are still unaware of the threats it poses to their portfolios. Too many investors still hide behind the naive illusion that inflation is only transitory. And they hide behind the fact that the wolf will disappear after a short time without causing any damage to their portfolios. But our view has always been inflation is the Achilles heel for balanced portfolios. But now, the wolf is also joined by a bear, the bear symbolizing a recession. Ladies and gentlemen, we are at the dawning of stagflation 2.0. Last year, we focused on the topic of monetary climate change, quite accurately predicting the higher levels of inflation that we are witnessing today. Now we are moving into a period of stagflation, a term that was coined in the 1970s to describe the economic situation at that time. The classic definitions of stagflation are largely qualitative and vague. So to make it easier to operationalize, we came up with our proprietary definition of stagflation, one which is purely quantitative. We define an economy as stagnant if real economic growth is less than 1% year on year. We consider inflation to be elevated if it exceeds 3% year on year. Both these conditions must be met for at least 2 consecutive quarters in order to declare a stagflation. Now, the situation today has some similarities to the 1970s, especially in terms of monetary and geopolitical policy, but also certain circumstances are significantly different. Very importantly, debt levels are more than twice as high as in the 1970s. And this renders a rigorous monetary policy to combat inflation virtually impossible. Let's not forget, ladies and gentlemen, Paul Volcker defeated stagflation in the 1970s by raising interest rates up to 20%. Now, we know that negative real rates are the foundation of every gold bull market. And we believe that a return to sustained positive real interest rates is as likely as a remarriage between Johnny Depp and Amber Heard. Now, what does that mean for investors? Well, obviously, stagflationary phases are a great challenge for investors. The classic mixed portfolio consisting of 60% stocks and 40% bonds has a diversification problem due to the positive correlation between stocks and bonds. Inflation is like kryptonite for bonds and equities. In the last 90 years, there have been only 4 years in which both US stocks and bonds had negative performance in the same year. Currently, all indications are that 2022 could be the 5th year. Therefore, there is a need for a portfolio diversifier. Gold has usually done quite well as a portfolio defender, as you can see on this chart. Now, there's also lots of further arguments for the emergence of stagflation. The enormous cash overhang of recent years. Then, globalization has obviously come under considerable pressure, first from the COVID-19 pandemic and since Russia's attack on Ukraine, from what seems to be the emergence of a second Cold War. Food prices are skyrocketing, as well as fertilizers. The first signs of a price-wage spiral can already be seen. The structural shortage of labor, in particular due to demographic change, is giving employees more and more bargaining power. The energy transition in the West will greatly increase demand for green commodities, which are already in short supply. But nevertheless, inflation rates might come down in the coming month. But we believe that they will remain well above the central bank's inflation target of 2% over the next couple of years. As in the 1970s, we will see several waves of inflation, and this will change the investment environment in the years to come. Stagflation means an extraordinarily challenging environment for investors. Conventional investment concepts, shaped by the disinflation of the past 4 decades, are already starting to cost their investors dearly. As a consequence, in the report, we cover the advantages and disadvantages of different asset classes in a stagflationary environment. This includes, obviously, precious metals, mining stocks, commodities, commodity currencies, Bitcoin, bonds, and real estate. But let us now have a quick look on the price of gold over the last couple of months. For gold investors, 2021 was somewhat disappointing. Many people asked if gold had lost its mojo. But we have to take into account that expectations were exceptionally high. As 2019, where gold was up 18% in dollar terms and 21% in euro terms, and also 2020, where gold was up 25% in dollar terms and 15% in euro terms, were fantastic years for gold investors. So gold had to take a breather. In the last couple of months, gold has fulfilled its role quite well. In our opinion, gold has provided stability and calm to portfolios in the wake of recent volatility. As we call it, gold is the Robert Petzel, or for our non-Austrian football fans, the Virgil van Dijk of portfolios. The gold price has stood up to the collapsing equity markets, bond markets and crypto markets, as well as the rallying US dollar, which is currently acting like a wrecking ball. However, since April, the price of gold has been impacted by the Federal Reserve's tightening. Provided that monetary policy departs from the current hawkish path, which is what we honestly expect, we think that gold could make new all-time highs in the next couple of months ahead. And if we zoom out and take a longer-term view, we see that gold's performance remains outstanding. Since the IPO of gold on August 15th, 1971, the average annual performance of gold in US dollar terms is 10.1%, while the annualized growth rate, the CAGR, is 7.9%. Tax-free, one has to add. Last year, and also this quarter, the average gold price has reached new all-time highs. On the 8th of March this year, we almost reached a new all-time high when the gold price reached 2,070 US dollars. And gold went on to end the first quarter of 2022 on its highest quarterly close ever. In euro terms, have a look at this chart. We made new all-time highs. So actually, ladies and gentlemen, from our point of view, gold does much better than most people currently think. In our view, 2022 will mark a turning point for the international monetary system. Credit Suisse star analyst Sultan Posa wrote that we are witnessing the birth of Bretton Woods III, a new world monetary order centered around commodity-based currencies in the East that will likely weaken the euro-dollar system and also contribute to inflationary forces in the West. Therefore, we have again dedicated an entire chapter on the outlook for the so-called de-dollarization. We explore why the freezing of Russia's currency reserves is comparable to Richard Nixon's closing of the gold window in 1971. And we discuss the increasing cooperation between Moscow and Beijing and the deteriorating relationship between the US and Saudi Arabia. Now, what will the world's monetary architecture look like when the dust finally settles? A mix of international currencies, possibly backed by commodities, gold, or even Bitcoin, is a probable answer. Other possibilities include a dual IMF system with the China-Russia alliance on the one side and the powers of the West on the other side. Gold will almost certainly play an increasingly important role as a reserve asset on the sovereign level, as gold is neutral, liquid, and doesn't have any counterparty risk. In this chapter, for the first time, we have also included a timeline of world monetary history since 1944, which we are really proud of. As usual, we also take a very close look at mining stocks. Well, the performance of mining shares over the last 12 months has been quite disappointing. Developments on the operational side, on the other hand, were excellent. Within the commodity sector, no other sector currently shows higher margins than precious metals producers. While the gold price almost reached a new all-time high in the spring, the valuation of gold mining companies does not yet reflect their sharp increase in profitability. Therefore, the value proposition of mining stocks has, from our point of view, improved even further. But so far, this rediscovered profitability of the mining sector has been largely ignored. But sooner or later, ladies and gentlemen, generalists and also value investors will rediscover the value proposition of the mining sector. What matters is that the sector produces significant amounts of free cash flows, as you can see on this chart. Companies in the commodity sector have become true cash flow monsters. While the majors like Newmont have marked new all-time highs in spring, the juniors and also the developers have been largely ignored. It reminds us very much of the fabulous video of the dancing Sasquatch guy that we mentioned last year for the first time. We also look at the challenges that the mining industry currently faces. This ranges from growing production costs to problems with permitting, political instability, and of course declining reserves due to a lack of new discoveries. And lastly, we believe that the royalty and streaming sector will do quite well in this environment, and therefore we dedicated an entire chapter to exploring this segment of the market. Is gold already too expensive? We often hear this question from clients, journalists, and private investors. Despite the significant nominal price increase in the previous years, it should not be forgotten that the inflation-adjusted all-time high from 1980 of $2,427 is still far away. In the In Gold We Trust Report 2022, we present many reasons why gold can be considered very far from being overvalued. Now, ladies and gentlemen, that was a short overview of the most important topics of this year's report. Further highlights of this year's report with a length of almost 400 pages, so we reached a new all-time high. We interviewed two high-profile thinkers, Luke Roman, one of the most inspirational global macro strategists. We talked with him about his views on the end of the US dollar as a global reserve asset, the situation in Ukraine, and what this all means for gold. Then we also talked to legendary gold investor Alistair MacLeod about the topic of stagflation. Then we feature a piece by our great friend and long-term contributor, Heinz Blasnik, who unfortunately passed away last year. We also look at how and why the Roman Empire lost its reserve currency. Spoiler alert, debasing the currency did play a quite important role. There's also another chapter about the international focus on ESG issues and how adding gold improves your portfolio's ESG profile. We take a closer look at silver and why we maintain our long-term bullish outlook on the metal. There's also a chapter on the political, social and economic developments in China and the impact that they might have on the demand for gold. Then Dietmar Knoll lays out his synchronous equity and gold price model. And of course, no In Gold We Trust report would be complete without a rigorous technical analysis. And then, of course, we present an update to our gold price forecast. We stick to our long-term price target for gold of $4,800 by 2030. And for the gold price to remain on track to reach this target, we expect the gold price to reach $2,200 by the end of this year. This would mean a new all-time high. Is this realistic? Yes, we believe that it is a realistic target, because as soon as the Federal Reserve is forced to deviate from its planned course, we expect the gold price rally to continue and new all-time highs to be reached. We believe it is illusory that the Federal Reserve can deprive the market of the proverbial punch bowl for any length of time, and we seriously doubt that the transformation of doves into hawks will last. Most hawks will merely turn out to be doves in hawk's clothing and will shed their hawkish garb sooner rather than later as a result of the consequences of the ongoing monetary tightening, recession, rising yields, stock market corrections, bankruptcies, and unemployment. And lastly, as a little special, we again visit the Oktoberfest and discuss the beer purchasing power of gold. And we also look at the price of an iPhone measured in gold over the last 15 years. Another spoiler alert, gold is protecting your purchasing power quite well, measured in beer at the Oktoberfest, but also measured in iPhones. Ladies and gentlemen, that was a brief, not so brief, overview of the highlights of our In Gold We Trust report 2022. We are very proud about the new edition, and I would like to thank you on behalf of the whole team and all our premium partners for your interest. Studying, understanding and appreciating the past is critical to preparing for the future, and understanding and preparing for Stagflation 2.0 is, in our view, the key analytical challenge of the present. Now we invite you to studying our annual tour de force and hope that you will enjoy reading our 16th annual In Gold We Trust report as much as we enjoyed writing it. Have a look at our webpage ingoldwetrust.report/en, where you can download the report completely free of charge. Ladies and gentlemen, many thanks for your interest, and remember, in gold we trust. Thank you very much.